A very warm welcome, good morning, good afternoon. Welcome to HYCM's Leveling Up workshop with myself, Giles Coughlin, Chief Currency Analyst. Hope everybody's doing well. Well, good to see you, Kingsley. Josh, good to see you too. Johan, Jabin, and just as other folks are coming into the webinar, just going to remind ourselves that any trade entries, exits, we will look at different support resistance, and we're looking at a specific currency pair today. Remember, all of this is from an educational perspective. The whole idea of this webinar is not trading advice. The whole idea is you look over my shoulder, someone with a professional trading background, you see how I go about making trading decisions, and the idea is that that's meant to be a pattern and a kind of a blueprint about how professional traders and analysts analyze financial markets. So just to make that clear as we get going, a very nice welcome to you. Now, I've got something, I'm really excited to be sharing this with you today. I'm going to be sharing how to use expectancy in your trading. Now, expectancy is a really important aspect, right? And for many traders, they see risk reward as all that they need to think about when they're deciding whether to take or trade or not. But actually, expectancy is extremely important. If you don't know what expectancy is, don't worry, because I'm going to share it with you. I'm going to explain what expectancy is, and I'm going to give you a template of a Excel spreadsheet so you can calculate expectancy yourself. I'm going to run through it. Now, the way I'm going to run through it, I'm going to run through it with a trade that I'm currently in. Now, for those of you who are aware of my process, I have this very simple image to help us with currency trading. Just as we expect the strong arm to beat the weak, we want to find currencies that have reasons for strength and pair them with currencies that have reasons for weakness. Okay, strength against weakness. In this instance, we'd expect, okay, on a balance of probabilities, you'd expect this stronger arm to beat the weaker arm, right? This smaller arm. Well, in the same way, when we pitch strong currencies against weak currencies, there's greater prospects of that becoming a successful trade. So as a result of this, I want to share with you a trade that I'm currently in. I'm just going to go over to my other screen. I'm just going to run through with you when I took this trade, and I'm going to show how I used expectancy to know whether to take the trade or not. So I'm just going to go over here. I'm just going to get the right screen up. Yeah, here we go. I got the right screen. Yeah, okay, great. Now, yesterday, I took a trade and I flagged it up here on Twitter just so you can see that, you know, it's a trade I was taking in real time. Let me just find the tweet that I made. Yeah, here it is. So you can see 18 hours ago, I said, Euro New Zealand dollar sellers make sense ahead of the Reserve Bank of New Zealand's interest rate meeting. Even if they do not hike by 50 basis points, they should at least expand their forward guidance. I see a 70% chance of a hawkish tilt. COVID cases rising in Europe, yield spreads diverging, Euro New Zealand dollar short is logical. So this is a trade I've entered earlier in the week, and I still am short in the trade. Now, I'll explain the outlook now, and then I'll explain how I used expectancy to know whether it was worth me taking the trade ahead of the RBNZ meeting. Now, the euro is finding weakness on rising COVID-19 cases. Austria in a lockdown. Germany might be heading into a lockdown. And if you looked at the latest German data, you can see the latest IFO business climate and expectations and conditions are all lower than expected. It's not a surprise. Supply chain issues are weighing on the euro, and Germany is the powerhouse for Europe as a whole. So it's the largest contributor to European GDP. So if Germany struggles, the whole of Europe is struggling. So, okay, great. That makes sense of the euro downside. Now, the New Zealand dollar The RBNZ met last night, and we have here their interest rate meeting. Now, you can see the release date, 24th of November. Now, it's being billed as a sort of dovish hike. So the RBNZ did hike by 25 basis points, but I've been looking at the data, and I think this is more optimistic than the market is initially thinking. So first of all, yes, they did say that the recent nationwide health-related lockdown has resulted in a sharp contraction in economic activity. But Reserve Bank of New Zealand is coming out of these restrictions at the end of this month. And notice how they say, despite these lockdowns, underlying economic strength remains supported by aggregate household business balance sheet strength, fiscal policy support, and strong export returns. So if you take a look at their the data, you can see that there is economic growth is being revised up. This is the RBNZ's figures. So they're expecting economic growth to rise. They're also seeing household spending on the rise, and the accumulated savings, which were building up during COVID-19, haven't dissipated. So in other words, households are spending, they still have savings, so GDP is expected to move higher. On top of that, they're also expecting inflation to move higher. Now, inflation is high and is expected to rise. Wage inflation is actually rising, and the unemployment was at a decade-year low at that sub 3.5% labour force. So that only 3.5% of the labour force was actually unemployed. So fantastic levels, and actually in the minutes, the they say employment is now above its maximum sustainable level. A broad range of economic indicators highlight that the New Zealand economy continues to perform above its current potential. So in other words, it's doing very well, and headline CPI inflation is expected to measure above 5% in the near term, but they do expect it to return to transitory. So when you start to look at the actual details of their monetary policy report, you can see that their CPI data, they were expecting inflation to be at 3.7. They're now expecting to be 5.7%. But that is huge. So in other words, they've rapidly revised
incoming mail
inflation expectations. They've also revised it up to 2.9 for 2023, and then falling back to 2.1 in 2024. So the latest projections on the right compared to the August projections on the left, they expect inflation to be higher. The only tool they have to control inflation is to raise interest rates. Then look at the trade weighted index against the US dollar. They're expecting that to rise in 2022, 2023, 2024. Great. Look at the OCR, the official cash rate. They're expecting that to rise by 50 basis points in 2023 and another 50 basis points in 2024. Look at the GDP output. Yes, they're expecting it to fall to 4.5. That's obviously because of the recent lockdowns that came in after the last August meeting. But can you see here that the 2023 GDP data is coming in at 4.2 for 2023. It was 2.4. So they're expecting a lot of that GDP growth to carry on. Look at unemployment. They're expecting that to drop from 3.9 this year to 3.3. And for 2023, they're expecting it's 3.6. So fantastic data points that the RBNZ are expecting. On top of that, let me show you something else. Notice this. The 2022 projections in the August meeting, they were expecting an official cash rate of 1.6. Now they're expecting it to 2.1%. So 50 basis points higher. Similarly, they're expecting in 2023, they were expecting a 2% interest rate level. They're now expecting that to be at 2.6. So more than 50 basis points. So 60 basis point increase. So when you stop and think about it like this, well, growth is revised higher, inflation is revised higher, employment revised higher. Official cash rate, revised higher. The medium-term outlook for New Zealand dollar strength really does remain very firmly in place. So the medium-term outlook for the New Zealand dollar remains strong. So you can see here, well, hang on. Now let's look at the bond yield spread. Now the bond yield spread just tells us what the yield spread differential is between the German 10-year and New Zealand 10-year. On a monthly chart, it's tilted to the downside. We have a clear selling down through that key support area. As that level breaks, we have a key resistance level up at that 1.63 region. It means we can clearly define risk either above 1.6500 or above that monthly chart, looking for a move lower, back down towards that 1.5400 region. Now, the euro is vulnerable to Germany announcing lockdowns. The euro is vulnerable to the ECB becoming more bearish in response to rising lockdowns. So on a balance of probabilities, more euro New Zealand dollar downside is expected. Now, the risks to this outlook. The risks to this outlook are as follows. If global growth slows and markets become concerned, then the New Zealand dollar will find weakness. Remember, the New Zealand dollar is a commodity-based currency. When the world's growing, New Zealand dollar, CAD, Aussie are supported. When the world fears global growth and they think that global growth is slowing, the New Zealand dollar weakens. That's risk number one. Now, the other risk, and this is the other trade that I am in, which is New Zealand dollar yen upside. Now, I favor New Zealand dollar yen upside because I'm expecting the RBNZ to remain in a very bearish. Sorry, I'm expecting the Bank of Japan to remain bearish, and I am expecting the RBNZ to remain on their hawkish setting. So over time, I would anticipate further New Zealand dollar yen buyers. We are at key support. We've got this key trend line coming all the way back to the 2014 high. So it means stops can be defined very closely just underneath that 79 region, around that 78, 70, 78, 60 region. Okay, so you can easily do that. And Josh asked, would you use Fib retracement as a tech level? 61% and 100 daily EMA at 78, 88. Absolutely, Josh, that's absolutely fine. No problem at all. Fib retracement levels offer good support and resistance levels. So the obvious one is that 50% region, that's 78, 50, 60, and you've got another one at 78, 88 New Zealand dollar yen. So I've got that. You always draw it from the left to the right. I wonder if you're going from this level here. I think you are. Either way doesn't matter. Yeah, you're doing it from this low. It's absolutely fine. Whether you go from this low or that low doesn't make any difference. You're just using it as support and resistance. And we're right in that decent 50% support level. Stops underneath 78.43 would make sense because that is a near-term resistance level. So medium term, we expect. Now, the problem with this trade, the risk, is that if risk-off trading comes on, we'd expect more yen strength. So if we see volatility push higher in the VIX and we see equity markets continue to sell off, then watch out for that. So look at this index, that blue line, that's the move index. Because if we get volatile moves in the yield bond market, as signified by the move index, if you want to check it out, look at this symbol here, right? So this is the symbol info. That's the ticker TVC:move. That's the volatility index for the bond market. So when this rises, often it will signal a rise in the VIX as well. Can you see that often a rise higher in the bond market leads a rise higher in the VIX? And the VIX is the volatility index of the S&P 500. So in other words, when the VIX rises, the candlestick chart, expect equity markets to fall, okay? When the move index rises, sometimes that will drag the VIX up higher. The bottom line is when we see disorderly moves in the bond market, it disrupts the equity market. So that's what we're looking for here, okay? So look for disorderly moves in the bond market. to potentially disrupt equity market. And if we see heavy equity selling, then that could result in some yen strength. So that's a near-term risk. And we are seeing risk-off trading at the moment. That's why that New Zealand dollar is being pressured right now with the yen strength. And also, some market participants were expecting a 50% basis point hike from the RBNZ. So there's maybe a little bit of disappointment in the markets today. Medium term, would expect that New Zealand dollar Japanese yen trade to continue moving to the upside. But we can define risk carefully with just underneath either that 79 region or underneath 78.37, looking for a move back up to 82, or with the Euro New Zealand dollar pair, we're looking for a potential move. If we go back above that 1.6500 region, we can look at liquidating the trade. But if we move back in line, we could join it. So it's not without risks. All these trades have risks, but these are two trades that I am in. Now, let me show you how I used expectancy to decide whether I wanted to take this Euro New Zealand dollar trade. Now, this is what I did. You can see here, I have a spreadsheet here. If you want to use the spreadsheet and you want an actual copy of it, please just like message me on Twitter or something, yeah, or LinkedIn. Just send me a personal message on Twitter or LinkedIn. There's my handle, and I can send you the actual. My handle's @Giles Cochran CCA, and I can send you the actual file. But I'll show you how to do it. So take a screenshot, and I'll give a screenshot of this as well for you. I'll show you the calculations, right? So this is what I was doing. I was looking at the Euro New Zealand dollar pair. So I thought, okay, well, this is the event, the RBNZ interest rate decision. I thought, well, what is the outcome that's likely? Well, either they're going to hike by 50 basis points, and I thought even if they don't hike by 50 basis points, I thought, do you know what? I think that they're likely to extend forward guidance. That for me was the most likely outcome. Now, I've just gone through this with you, and you know that's what they did do. The unlikely outcome that I saw was that they were hiking by only 25 basis points and didn't revise up the inflation expectations. That's what I was wondering, okay? And I thought, I could see if they did that, that would be the more dovish outlook. Now, then I was looking, how much is at risk? So you put how much is risk in B2 and B3 cells, and what would I stand to gain if I'm right? So this is what I'd start to get. This is what I'd stand to gain if I was right, and this is what I'd stand to lose if I was wrong. Okay. So I would lose 7,500. I would gain 9,500. Okay, in this calculation. I then looked at the probability of the event. Now, when I originally did this, I thought it's a 75% chance that they do what they do. And if it's a 75% chance that they hike or extend the forward guidance, then I thought there's only a 25 basis points chance, 25% chance that they just have like that very, very dovish outlook, which would obviously result in New Zealand dollar weakness. Now, then what you do is then you work out, you times the gain by the probability, and then that gives you the expected value. Then when you've got the expected value, you divide the expected value by the amount you've got at risk. Don't worry, I will show you how to do this, okay? So you divide the expected value by the amount you've got at risk, and that tells you the expectancy. So the expectancy is positive 52.5%. So that means the trade's worth taking, even though my risk reward is less than 1-to-1. It means logically and mathematically that if I took 100 of these trades, I would be making money. The expected value is 5250. Now, look what happens if I change the probability. Let's say that was, and this is what made me take the trade. I thought, well, and this is the weakness of the trade, the idea, and the weakness of the concepts. How do you know that the probability you're using is correct? All right. Now, for me, I was quite sure on this. I've been following the data for quite some time. The RBNZ, it always said, had also said that, that inflation, interest rate expectations are growing all the time. There was a throwaway line. I picked it up. And I thought, yeah, I expect them to extend forward guidance. So I gave it a 75% probability. But this is what made me take the trade. I thought, well, hang on. Let's say I'm wrong, and let's say it was only a 50% probability. So if there's only 50% probability, right, you can see then the expectancy is 10%. So it's still worth taking the trade, even though the risk reward is less than 1 to 1. Let's say now, for the sake of argument, that actually it was only 30% probability of that happening, and 70% probability that they have a more dovish hike. Then look, the expectancy is now negative. It's now not. It's not statistically worthwhile me taking the trade. So as long as you can get the probability right, this will tell you whether you should take the trade or not. And then for me, obviously, I thought 75%, 25%, right? So that's a positive expectancy, which is why I had the conviction to do this. You can see this is like 18 hours ago. November the 23rd, 5:54 p.m. So it's before the RBNZ meeting, and I said, look, Euro New Zealand dollar sellers make sense ahead of the RBNZ. Even if they do not hike by 50 basis points, they should at least expand their forward guidance. I see a 70% chance of a hawkish tilt. COVID cases rising in Europe and yield spreads diverging. Euro New Zealand dollar short is logical, okay? So, and I put this expectancy, right, as a little clue, and I was doing a little presentation on some of this to a group of German traders who just mainly trade the DAX and the Dow. And that's what I wanted to do. Okay, I wanted to highlight this power of expectancy, and I wanted to present it to you on this workshop so you can understand how that works, because many traders make the mistake of saying, oh, the risk reward is less than 1 to 1. It's illogical to take the trade. No, it isn't. Not if you understand probability. Okay, and it's great because you then know, oh, hello, you know, I have the conviction here that the trade I've taken it for the right reason. So if you want to set this up for yourself, or this is what you do. So in this, wherever you see the red, so take a screenshot of this. So make sure you get it. Take a screenshot now before it goes, and then I'll explain it to you. So if you do C2 times D2, that is the gain times the probability. So you can see 3,000, 90% of the time, your expected value is 2,700. If you lose the full position, minus 10,000, but only 10% chance of it going wrong, you minus 1,000. The total expected value is 1,700. So this is C3, that's the sell, C3 times D3, right? And then that's C2 times, so you put that formula into the spreadsheet and you get the expected value. Now, this is how you get the expected value as a percent of risk. That's just E5, which is expected value, divided by B2, the amount you have at risk. Okay, 10,000. So the expected value as a percentage of the risk is 17%. Great. You are in the money because you are using logic there to correctly identify a potential trade that makes sense logically. This is a good way, and now comes to understanding statistics and probability. So when you're trading, developing your statistical understanding and probability understanding is going to help your trading longer term. This is a very quick way of doing it with probability. Now, the problem, remember, is the probability. You've got to get that probability. If you get the probability wrong, that changes the expected value. So if your analysis is poor, right, then that's going to scupper you. But that, for me, when I took this trade, that gave me, I thought, because I was thinking, do I take the, Euro New Zealand dollar short? Do I not? I used the expectancy calculation and I saw it clearly made logical sense to take it. That if I took 100 trades like that over time, be right. And as it happens, look, my analysis was correct. Now, it doesn't mean that the trade is going to work. It doesn't mean that I won't get stopped out. Of course not. But what it does mean is that you're applying logic and reason, and you're making a logical case, right? And Yes, if the New Zealand economy starts slowing down, I'll have to reevaluate my outlook. Yes, if risk offsetting comes firmly in, I might have to reevaluate my outlook. But as things stand right now, it does make sense. So don't forget that you can do that. Now, actually, I am just going to try and send a file over to you now on the GoToWebinar control panel. Just give me a second, and I've got a Excel spreadsheet. Just going to try and drop this in. Just give me a second. It's not. Let me just see. I'm just going to see if I can choose a file and put it in. Oh, it's not letting me do it. Oh, hang on. Yes, it is. Right, let's try this. Expected value. Just going to try and send it to you to see if it will let me do it. No, it's not a supported format, so I might have to. No, sorry about that. Not letting me do it. I'll try one more time, see if I can get it another way. But either way, I think you've got the just seeing. Yeah, here we go. Okay, this is last chart. Yes, it's going across. Right. So you should see in the handouts now an expected value Excel version. So that is my gift to you there, folks. So enjoy. Okay, use it in your trading. It can just help you understand whether the expectancy is in your favor or if it's not in your favor. Yeah, no worries, Warren. I'm glad to be able to add value to you guys. Yeah, it is there. So make sure you've downloaded that. I'll leave it here. So it should be here next week. But if it isn't, just message me. Anytime, I'm happy to send it to you. So make sure you pick that up. I'm going to give folks 30 seconds or so before we exit, because we come to the end of our time. But I hope that is a really helpful tool. And I hope that just sort of helps you, adds a little bit of statistical probability to your trading. I think it's the sort of thing that can give you an edge, and certainly it can help you make that decision if you're a little bit uncertain whether to take the trade. Just drumming it down into the statistics and the probability of it should really help you and give you that extra conviction. It certainly is helping me. I've just only recently started using it, and before, what I kind of use as a gut instinct, I'm now able to scientifically put together and have that conviction. Aha, yes, my expectancy is positive. It is logical for me to take this trade. It's not just a hunch. And the problem with a hunch is that you can start to feel like uneasy, and you're only uneasy because of maybe you've got fear of missing out, fear of losing, and actually this helps you just rationalize your behavior a lot more. Okay, folks, thank you all very much. It's been an absolute pleasure. Don't forget, back next week, well, scheduled to be back next week on Monday for the Look Ahead webinar, and we'll be looking at NFP coming at the end of next week. We also have the OPEC meeting, which will be important after the latest shenanigans between the US and OPEC, and we'll be getting that recovered. Take care, everyone, and have a really good rest of the week. Thank you all. Goodbye.